In part 2 of the video, we have learned how to create an allowance for impairment of trade receivables in the first year. We will now look at what the business needs to do when it needs to increase the allowance for impairment of trade receivables at the end of the second year. The journal entry that has to be recorded will be the same as the creation of the allowance for impairment of trade receivables, which is debit impairment loss on trade receivables, which will increase the expense, and credit the allowance for impairment of trade receivables, which will increase the contra asset. However, we have to take note of a required ending balance, which will be illustrated in example 2. So this example continues from example 1. On 1st of January 20X2, the allowance for impairment of trade receivables had a balance of $600 credit. Now during the year ended 31st December 20X2, that means during this year, Tom and Carrie, which owed $100, was declared bankrupt on 31st March. Now this allowance was made on 31st December 20X1, which is the previous year. So you had made an allowance for this debtor. Now a second debtor, Apex Deli, was forced to close its operations on 30th April 20X2. So it was unable to pay its debt of $250. Now take note for this case, there was no allowance for impairment made the previous year for this debtor. Now the debt was written off to profit and loss. So on 31st December 20X2, estimated uncollectible debts amounted to $720. The amount comprises of these two debtors. So you're asked to do the following: prepare the journal entries to write off the debts. Prepare the trade receivable accounts for both debtors. The allowance for impairment of trade receivables account for the year ended 31st December 20X2. Extracts of the income statement and balance sheet showing the expenses and the current asset. Now to write off a debt that is no longer collectible, for example in this case the debtor becomes bankrupt, we will record the journal entry of debit allowance for impairment of trade receivables, which will reduce the contra asset, and credit trade receivables, which will reduce the asset. Now take note that the journal entry will be the same regardless of whether allowance for impairment was made in the previous financial period. So for this question, actually there are three things that you need to take note of. Number one, the business had made an allowance for impairment of trade receivables and for Tom and Carrie, and is now writing the debt off. Number two, the business had not made an allowance for impairment of trade receivables for a debtor in the previous year for Apex Deli, this one, and it now has to write the debt off. Now number three is, after taking into account the writing off of the debts, the business has to increase the allowance for impairment of trade receivables to $720 credit. This is what we call the required ending balance. So let's see how we record the journal entries to write off the debt first. The journal entry to write off a debt, remember, is to debit your allowance for impairment of trade receivables and credit trade receivable of the debtor who can no longer pay. So for this case, we will write debit allowance for impairment of trade receivables $100, which is the amount that is owed by this debtor called Tom and Carrie. So you debit allowance, credit trade receivable. Now the date here will be the date that you know, the business knows that the debtor cannot pay. So for this case is 31st of March. Now there was another one during the year, which is April 30. Again, you do the same thing. Even though no allowance has been made for this debtor, you will do debit allowance for impairment of trade receivables for the amount owed, which is $250, and you credit trade receivable Apex Deli, again for $250. So take note again that even though we did not make an allowance for impairment of trade receivables for Apex Deli, we will still debit the allowance for impairment of trade receivables when we write off the debt. So how does this writing off of the debt affect the trade receivable accounts for the individual debtors? Let's take a look. Now remember to write in the balance brought down for this trade receivable account. And so firstly we write in the balance brought down first. So 1st of January, for Tom and Carrie, you have a balance brought down of $100 debit. Since we debit allowance for impairment of trade receivable account and credit trade receivables for Tom and Carrie, we will write $100 in the credit column of the trade receivable account and write allowance for impairment of trade receivables here. Since this is account that we debit, now we will have a zero balance in the trade receivable account of the debtor after this. Now, so the date here will be March 31st. Now similarly, to write off the trade receivable for Apex Deli, we will do the same thing. So write in the balance brought down of $250 in the beginning of the year, then credit the trade receivable account for $250 and debit your allowance for impairment of trade receivable. So the date here will be April 30. Again, you should notice that the balance of the trade receivable account will be reduced to zero after the writing off. Now for the allowance for impairment of trade receivables account, the first thing that you should check is whether there is any balance brought down from the previous year. Now in this example, there is a balance brought down of $600 from the previous year. So we have to record this on 1st of January 20x2, which is the first day of the financial year. So balance brought down $600 credit. The next entry will be when we write off the debt for Tom and Carrie on 31st March. So March 31st, we actually debit allowance for impairment of trade receivables for $100. So we debit this account, so we write $100 here. And we write trade receivable Tom and Carrie, as this is the account that we credit. Write in the balance of 500 credit. Now next, on April 30, we write off the debts of Apex Deli. So we do the same thing and debit allowance for impairment of trade receivable accounts by 250, and we write trade receivable Apex Deli here. The date will be April 30. So the balance here will be 250 credit. Now at this point in time, read the question again. It says that the estimated uncollectible debts amounted to 720. This one. The estimated uncollectible debts amounted to $720. This means that the final balance for the allowance for impairment of trade receivables at the end of the period has to be $720. So we write in the date of December 31st. And the final balance of 720 credit first. Now this is the amount that is known as the required ending balance. Is what is given to you for that whole year. This is the amount that is probably uncollectible. So required ending balance. Now take a look at your balance for the allowance account right now. You already have a balance remaining of 250 credit. Now in order to increase to a balance of 720 credit, you just need to credit the account by the difference of 720 and 250, which is 470 credit. Therefore, we write 470 in the credit column here and not 720. The account that we debit is impairment loss on trade receivable, so we write here. Now lastly, remember to bring down the balance to the next year 20x3 January 1st. Balance brought down 720 credit. Now next we look at the extract of the income statement and balance sheet for the business ice jelly. The impairment loss on trade receivables that will be listed under less expenses. So we have impairment loss on trade receivables. However, the amounts will be 470, which is the required ending balance of $720 minus the existing balance before the end of the financial year. So this one is actually 720 minus 250, where this one is your required allowance, required ending balance of the allowance, and this is the existing balance before end of financial year. So take note, this is 470, which is from here, and not the whole amount of 720. Now for the balance sheet under current assets, we write down trade receivables, and the total amount that is given to you, which is 18,000. Then we less the allowance for impairment of trade receivables. Okay, which is 720, because the balance is, that is what you want inside your, that is what is unlikely to be collectible, so 720. And you have your final net trade receivable. Which is the difference between these two. So you have 17280. So your extract of the balance sheet will be done. In the next video, we will look at how we decrease the allowance for impairment of trade receivables account.